On January 6, 2026 at 7:54 p.m. Eastern, a Form 4 lands inside the SEC's Edgar archive under Tesla's name. 60,000 Tesla shares are reported as sold 4 days earlier, on January 2nd, at a weighted average price near $445.40. Roughly $26.7 million is converted from equity exposure into cash, executed under a Rule 10b5-1 trading plan. The reporting person is not a headline celebrity and not a day trader. It is Tesla director James R. Murdoch. And if Tesla sits inside your ETF, your pension, or your 401k, this changes the risk profile of your passive portfolio in a way most people never measure. What if everything you believed about insiders panicking was wrong? This is not a panic story. It is a late-cycle liquidity story. A planned sale can still be a signal because the signal is not emotion. The signal is timing, sizing, and the macro regime in which liquidity is chosen over optionality. This unfolds in 4 stages. Stage 1 is liquidity expansion. Credit is abundant, money is cheap, and future earnings are priced as if the discount rate will stay suppressed. Stage 2 is narrative concentration. Capital crowds into symbols, and indexes become top-heavy because the same few names attract the same flows. Stage 3 is insider liquidity. Exposure is reduced into strength while the public story stays bullish, because insiders manage probability, not headlines. Stage 4 is regime repricing. Multiples compress, correlations rise, and volatility becomes the tax that late-cycle portfolios pay. This is not prediction. This is pattern recognition from a century of market data. Throughout the last 100 years, the timeline varied, but the sequence never changed. The cycle is not mystical, it is mechanical, because liquidity is mechanical. A 10b5-1 plan does not erase meaning. It is a pre-committed mechanism to turn stock into cash under a legal defense framework. The real question is why the plan exists, why the sizing is what it is, and why the conversion happens into this specific environment. Now, watch what history does when Stage 3 begins. In each major cycle, the crowd believes it is early. Then the discount rate moves, and the crowd learns it was late. Case study 1 is Japan, where a domestic boom became a global warning. In the late 1980s, Japan's equity and real estate prices inflate inside a credit system that assumes stability as a permanent condition. Leverage looks conservative because collateral keeps rising. On December 29, 1989, the Nikkei 225 closes near 38,915, the apex of the era. It is a national narrative as much as it is a market level. By 1990, the Bank of Japan has tightened monetary conditions, and the cost of money rises into assets priced for a forever boom. Collateral values begin to wobble. In that era, the policy rate reaches 6% by August 1990. And the tightening collides with a market priced for perpetual appreciation. By December 1990, the Nikkei trades near 21,902, a loss of more than 40% within a year. The market does not wait for economists to name the regime. The market imposes it. By August 1992, the Nikkei is down roughly half from the peak, and the decline is no longer a chart. It becomes bank balance sheet stress. Japan does not run out of innovation. Japan runs into Stage 4, where the multiple meets the regime. When the multiple is built on cheap funding, higher funding is enough to break it. Case study 2 is the dot-com cycle, when technology was real, but valuation still obeyed arithmetic. In March 2000, the Nasdaq Composite peaks after years of capital formation, and a story that connectivity has repealed recessions. Risk is not priced because the crowd believes the new system is different. Between 1999 and 2000, the Federal Reserve raises rates as inflation and speculation build. Financial conditions tighten into a market priced for perfection. By May 2000, the federal funds rate reaches about 6.5%. That is the cost of money colliding with a market that is priced capital as free. When growth expectations disappoint, the repricing becomes historic. By late 2002, the Nasdaq has fallen roughly 78% from peak to trough. The same pattern appears. Liquidity expands, narratives concentrate, Insiders and institutions migrate toward liquidity, and then the market reprices what it is willing to pay for distant earnings. The internet survives, the multiple does not. Case study 3 is 2008, when the plumbing of credit turns a valuation problem into a solvency problem. In the mid-2000s, housing is treated as a one-way asset. Securitization is treated as a machine that removes risk. Funding markets are treated as always available. When collateral is questioned, the system's leverage becomes visible. By September 15, 2008, Lehman Brothers files for bankruptcy. After that date, volatility migrates from implied to realized. Credit spreads widen, equities fall, and central banks are forced into emergency intervention. In 2007, the Federal Reserve's balance sheet is under $1 trillion. Within the crisis, it expands by the trillions as lender of last resort becomes the only backstop strong enough to stop the spiral. That intervention prevents collapse, but it also teaches the market a dangerous lesson. Risk can be subsidized. Stage 1 becomes easier to restart. The point is not the specific villain, it is the sequence. 3 different decades, 3 different economies, identical 4-stage cycle. Now bring the pattern forward to Tesla and to the financial geopolitics that surrounds it. Right now, today, as of January 28, 2026, Tesla is not merely an automaker. Tesla is a macro instrument, embedded inside passive funds that automatically route household savings into the same concentrated set of equities. In Invesco QQQ, Tesla is about 3.8% of the portfolio by weight. In SPY, Tesla is around 2.1% by weight. That matters because owning the index means owning Tesla volatility, whether you chose it or not. If Tesla is 2% of a broad ETF, your retirement account inherits Tesla's drawdowns, its rallies, and its valuation compression risk as a built-in feature. And this is happening in a regime that is no longer Stage 1. As of January 21, 2026, the Federal Reserve's consolidated balance sheet shows total assets near $6.58 trillion. Liquidity is still large, but the direction is not a perpetual acceleration. As of January 26, 2026, the effective federal funds rate prints around 3.64%. That single number is a gravity field for growth multiples. That rate sits inside a target range that markets are now treating as stable, after a 2025 easing cycle brought policy down to roughly the 3.5% to 3.75% band. Stability is comforting until it becomes a constraint. In late cycles, rates on hold can mean risk on hold, and the smallest shock becomes a large repricing event. Treasury funding adds another layer. On January 27, 2026, the U.S. Treasury auctions about $90 billion in 6-week bills, pulling cash from money markets and forcing investors to choose between short-term yield and long-duration risk. That choice repeats every week, at scale. It is a quiet liquidity tax that did not exist in the same way during the era of zero rates. The discount rate is not a narrative, it is a price. When the discount rate is higher, the market demands a lower multiple for the same future cash flow. That compression can occur even if the business keeps executing. Now add volatility. As of January 26, 2026, the VIX closes around 16. The bond market's volatility gauge, the MOVE index, sits near the mid-50s. Those are not crisis readings. They are a baseline that can jump when geopolitics touches inflation, and inflation touches rates. And geopolitics is touching rates. In late January 2026, markets are not only digesting earnings. Markets are digesting institutional credibility, tariff threats, and the political pressure that surrounds central bank decisions. When investors lose confidence in the rulebook, the price of capital rises. The repricing begins in duration assets first. This is why the Murdoch sale belongs in a macro documentary, not a celebrity feed. The Form 4 states the transactions were executed under a Rule 10b5-1 plan adopted on May 20, 2025. That detail is important because it removes one easy interpretation. It is not reactive panic to a single headline. It is pre-committed conversion into liquidity. But the plan does not answer the real question. The macro regime answers the real question. On January 2, 2026, Tesla also publishes its quarterly production and delivery update. The company reports production of over 434,000 vehicles, deliveries of over 418,000 vehicles, and energy storage deployments of 14.2 gigawatt-hours. Those numbers matter because they show the business is active and real. And yet valuation is not a reward for reality. Valuation is a price for certainty. This is the late-cycle divergence most portfolios miss. Retail narratives stay bullish because the product is visible, the brand is visible, and the future is emotionally attractive. Insiders and institutions de-risk because they are priced in the currency of liquidity, not the currency of optimism. Stage 3 is not a collapse. It is the quiet recognition that upside is capped by the multiple, while downside is opened by the regime. Look at the scale. Tesla's market capitalization is roughly $1.4 trillion in late January 2026. Its trailing PE is reported around 300 on major market data services. That is not an insult. It is a measurement. That single statistic explains why late cycles can be brutal without a single scandal. If a company trades at 300 times earnings, the market is paying today for decades of expected performance. When the regime changes, the market can decide to pay 200 times or 150 times without changing its view on the product. A move from a 300 multiple to a 200 multiple is a one-third price decline even if earnings are flat. A move from 300 to 150 is a 50% decline without a recession. That is the real risk of stage 4. It is not that the business disappears. It is that the price of certainty collapses. A PE that high means the stock is priced for a long runway of growth and margin confidence. It means the multiple is sensitive to the discount rate and to any shift in geopolitical or policy risk. In a stage 1 environment, the market is willing to pay for that runway. In stage 3, the market becomes less willing to pay for distant certainty, because distant certainty is no longer cheap. This is why insiders do not have to be bearish to sell. They only have to be rational under a regime shift. A director does not need to predict a crash. A director needs to manage the distribution of outcomes, and the distribution is widening. The Form 4 shows the selling is executed across many small line items, spread through price ranges from roughly $435 to $458. That structure reveals intent. It is designed to convert exposure into cash without forcing one dramatic print. It is a professional liquidation pattern, not an emotional exit pattern. Meanwhile, the public sees the same chart and interprets it through a story. This is where the geopolitics layer becomes decisive. Tesla's supply chain sits inside strategic minerals and industrial policy. Batteries depend on lithium, nickel, and graphite, and processing capacity remains geopolitically concentrated. Trade policy is no longer a side story. It is the cost structure. Tariffs, export controls, and subsidy battles are not just political theater. They are inputs into margins, demand, and the inflation path. The inflation path matters because the inflation path is what the bond market prices, and the bond market is what sets the discount rate. That is the chain of causality most retail investors never model. In the last decade, markets were trained to believe central banks would rescue risk assets quickly. That belief lowers perceived risk, which raises the multiple. But late-cycle regimes are different. When deficits are large, the ability to cut rates without consequences shrinks. When geopolitical shocks are frequent, inflation becomes less predictable. When inflation is less predictable, bond volatility rises. Bond volatility is not a technical detail. It is the heartbeat of the valuation system. Now watch the passive flow machine. BlackRock reports roughly $14 trillion in assets under management at the end of 2025. Vanguard manages an even larger pool globally. These pools feed indexes, and indexes feed the same top holdings, and those holdings dominate the performance of retirement portfolios. That pipe has a behavioral feature that matters in late cycles. When markets rise, inflows chase performance and reinforce concentration. When volatility rises, many institutional strategies mechanically reduce equity exposure to maintain a volatility target. That means selling can become programmatic, not emotional. It is the modern version of a margin call. distributed across portfolios that never thought they were leveraged. It creates the illusion of diversification without the reality of diversification. You may own 500 stocks through an ETF, but your returns and drawdowns are heavily governed by the same top-weight names. This concentration is Stage 2 made structural. And when Stage 2 becomes structural, Stage 4 becomes systemic. A repricing is not contained inside one ticker. In a systemic repricing, the index behaves like a single crowded trade, because flows become correlated and liquidity becomes the only variable. This is why a director's liquidity decision matters even if the business remains strong. It is a micro action that points at a macro regime. Now consider the household perspective. If you are under 40, your retirement contributions are likely automated, and your allocation is likely dominated by equities through target date funds. That means you are structurally long-duration equities without consciously opting in. You buy the future every pay period, regardless of the discount rate. If you are near retirement, your vulnerability is not just a crash. Your vulnerability is a year of volatility clustering that forces buy high, sell low rebalancing at the wrong time. Late cycle volatility does not ask whether you have time to recover. This is why the word signal must be used carefully. A signal is not a prophecy. A signal is a probability tilt. Stage 3 signals that the probability of multiple compression is rising, even if earnings continue. Stage 3 signals that volatility spikes become more likely because the market is priced for low uncertainty while living in high uncertainty. Stage 3 signals that correlation increases because passive flows compress the system into fewer outcomes. And Stage 3 is where we are. The policy data supports it. The effective federal funds rate at 3.64% is not restrictive in historic terms, but it is restrictive relative to the assumptions embedded in very high multiples. The Fed's balance sheet near $6.58 trillion is still large, but it is no longer expanding at crisis pace. Fiscal data also matters. Federal debt held by the public is reported above $30 trillion in the latest quarterly data. Treasury financing continues on a scale that forces global capital to constantly decide whether U.S. duration risk is worth the price. In a stable geopolitical era, that decision is easy. In a fragmented geopolitical era, that decision becomes volatile. Even modest shifts in foreign demand can move yields at the margin. Even modest moves in yields can reprice high multiple equities. That is the geopolitics to valuation pipeline. This is also why insider selling needs to be interpreted with discipline. Yes, insiders sell for many reasons: taxes, diversification, estate planning, philanthropy. But large planned selling waves by high-proximity directors and executives often appear when the cycle is aging because liquidity is most valuable before repricing begins. They do not need to be pessimistic. They only need to respect the math of regimes. And when the public stays bullish, the divergence becomes even more important, because divergence is the diagnostic signature of Stage 3. It is not the selling alone. It is the selling that happens while the story remains euphoric, the multiple remains high, and the macro regime remains uncertain. So what happens next over the next 12 to 24 months if the pattern holds? First, multiple compression can occur without a recession. In late cycles, the market can reprice from growth at any price to growth at a reasonable price. That is not collapse. It is a change in willingness to pay. A Tesla multiple does not have to fall to zero to hurt portfolios. It only has to fall from extreme expectations to ordinary expectations. Second, volatility clustering becomes normal. A VIX at 16 does not feel dangerous. But in late cycles, volatility does not rise smoothly. It gaps, it spikes, it forces leverage out of the system. And leverage exists everywhere, including in derivatives, in structured products, and in the hidden leverage of risk parity and volatility target strategies. When volatility rises, those strategies can de-risk at the same time, increasing correlation. Third, liquidity becomes selective. In Stage 1, liquidity is generous. In Stage 4, liquidity is expensive. Bid-ask spreads widen, market depth thins, and moves become larger on lower volume, because the marginal buyer demands a larger discount. This is why the warning signs matter. Three warning signs tend to show up before stage 4 accelerates. Watch bond volatility. If the MOVE index pushes above the high 60s and holds, it signals that rates uncertainty is no longer contained and hedging costs are rising. Watch the policy credibility channel. If rate expectations swing violently around political pressure, the market starts to price institutional conflict, not just macro data. Watch insider liquidity clusters. When large planned sales expand across multiple mega-cap index weights, it signals that proximity is choosing cash over narrative. None of these indicators is magical. Together, they map the weather. A fourth sign is credit. When high-yield spreads begin to widen while equities remain at highs, it is often the market's early warning system. Equity narratives can stay confident while the bond market prices higher default risk. A fifth sign is the volatility floor. If the VIX refuses to return to the low teens after spikes, it suggests that uncertainty has become structural, not episodic. In late cycles, a VIX floor in the high teens can be enough to force systematic strategies to carry less equity. And the purpose of mapping is not panic, it is positioning. Positioning does not mean abandoning equities. It means understanding that passive does not mean low risk when the system is crowded. It means recognizing that cash, short duration, and true diversification become more valuable when volatility becomes the tax. It means recognizing that a stock can be an extraordinary company and still be an expensive asset. The difference between company quality and asset price is the difference between admiration and analysis. This is why a Tesla director's Form 4 matters. It is a time-stamped liquidity decision, executed under a plan, priced across a range, and filed into a public archive with legal accountability. It is not proof of doom, it is evidence of behavior. Behavior is what cycles are made of. Insiders do not need to be right about the future. They only need to be early about liquidity. The public learns about risk when price falls. Proximity manages risk when liquidity is still abundant. Remember the 4 stages. Liquidity expansion builds the runway. Narrative concentration builds the crowd. Insider liquidity begins the quiet rotation toward cash. Regime repricing is the moment the crowd learns the runway was not infinite. The Form 4 does not tell you the date of the repricing. It tells you that proximity is already preparing for it. And when proximity prepares, exposure should be measured with discipline, not defended with belief. In real portfolios right now, a Tesla director sold 60,000 shares for roughly $26.7 million, executed on January 2nd and filed on January 6, 2026. It is a clean example of Stage 3 behavior inside a Stage 2 market. This is happening in a regime defined by a 3.64% effective policy rate, a Federal Reserve balance sheet near $6.58 trillion, and volatility that can wake up on geopolitical headlines. If your retirement account owns Tesla through SPY, QQQ, or any broad index product, you are exposed whether you realize it or not. You have a choice. Understand the 4-stage cycle and position accordingly, or ignore it and hope this time is different. But remember, this time is never different. The pattern is absolute. If this analysis changed how you read Director Form 4s, subscribe now. In the next video, this same framework will be applied to the next cluster of insider liquidity signals emerging inside the highest weight names in the largest retirement index funds. The liquidity shift is coming. The only question is whether you will see it before it arrives. What if everything you believed about insiders was wrong? Because this is not about panic. This is about liquidity. Markets run on stories, but they turn on mechanisms. The story is what retail investors are fed: personality, product hype, and the illusion that one figure explains every move. The mechanism is quieter. It is filed. It is time-stamped. It is numerical. A Form 4 is not a rumor. It is an audit trail. It shows you when someone with maximum proximity chooses to convert exposure into cash. And that choice tends to appear at the same point in the cycle, again and again, across decades of markets. This unfolds in 4 stages. Stage 1 is liquidity expansion. Credit is abundant, money is cheap, and valuations stretch because the discount rate is suppressed.